Hi, Mike Flores here, co-founder of Trade Prosper, and I want to welcome you to Section 8, Video 5. We're going to talk about the differences between margin and leverage in the different markets. Now, it is very important to understand these two key terms. They will play a huge part in our success and have been the cornerstone of success for the greatest traders of all time. So, Forex, margin and leverage. Now, why do professional traders make so much money? They use leverage. And leverage simply means that we will use a small amount of our capital to control a large amount in the market that we are trading. The primary reason we use leverage is to maximize our gains. Of course, it can have negative ramifications if you have poor risk management techniques. Now, obviously you don't, because we've taught you a great risk management technique. In Forex trading, the leverage is decided by the individual broker with whom you sign up. However, in the US, that leverage is capped by the Commodities Futures Trading Commission, CFTC. And basically, they say that they cap it at 50 to 1. This means that if you deposit $1,000 into your brokerage account, your broker will allow you to trade up to $50,000 worth of currency in the market. This is a leverage of 50 to 1. In this scenario, the margin to control $50,000 worth of currency is $1,000. Now, margin can be thought of as a good faith deposit to maintain open positions. Margin is not a fee or a cost. The broker takes the $1,000 out of your account while your position is open, and once you exit the trade, close the position, the good faith margin deposit is put back into your account. Now, this is pretty cool because we can control 50 times the amount of money in our account trading Forex in the US. This is going to be a huge key to our success. Now, for those of you outside of the US, I've seen it as high as 200 to 1, even 400 to 1 leverage. Now, remember, we don't fear leverage. It is one of our key edges. Now, in the futures market, the margin is the same thing as in the Forex market. It is the amount of money that you have to put up to control a futures contract. Now, futures margins are set by the exchange in which the contract trades. Now, some brokers add a premium to the futures margin to lower their risk exposure. Futures margins are usually somewhere between 5 and 15% of the value of the contract. Now, futures margins vary depending on the market you're trading and the volatility of the market. So, for example, right now, as a good faith deposit, you would put up $8,000 and you would control one contract of gold. The price of gold right now, let's say it's $1,300 per ounce. One contract of gold equals 100 ounces. So your $8,000 margin controls $130,000 worth of gold. That's a little over 6% margin. Now, there are also mini contracts you can use which have lower margin and lower contract sizes. Now, remember, we love leverage and margin because it allows us to supersize our profits. And with our risk management all sorted out, we have nothing to fear. Whenever you hear about the great traders, the Michael Marcuses, Ed Seykota, Marty Schwartz, Larry Hite, they all traded futures and Forex primarily. We want to be in the big boys game. We are not fearful. Remember, leverage and margin is a huge edge that we will use to our advantage. Now, the margin for stocks and ETFs is 2 to 1 for non-institutional traders, which is where we are all going to fall into. Now, the institutions, they can get up to 10 to 1 margin on stocks and ETF trading. So what does this mean? So let's say, for example, you have a deposit of $10,000 into your cash account. This means that you can buy up to $20,000 worth of stocks or ETFs on margin. So your broker basically lends you the extra $10,000 to purchase stocks or ETFs, and they will charge you an interest fee to borrow the money from them. Usually, the bigger the account value, the lower the margin fee. The interest fees vary from broker to broker. One thing to note, in the futures and Forex markets, you do not pay interest on margin. Now, although 2 to 1 margin is nowhere near the leverage we get in Forex or futures, whenever I can, I will trade a leverage account over a cash account, and I recommend that you do so as well when trading equities. Now, remember, that doesn't include options. Using options, we can get a lot more leverage, and my partner and colleague, Billy Fillion, will go over that more in his section of the course. Now, remember, again, as long as you stick with the 1% max rule per position, you won't have to worry about the leverage or margin being an issue for your trading. Now, that basically sums up everything that you need to know about margin and leverage. Alright, so I look forward to talking to you guys in the next video. Have a good one. Talk to you soon. Bye now.